Hello and welcome to Upstack America's Oracle EBS Financials Functional Training. My name is Bob and I'm the lead senior consultant for Upstack America. And with me today I have Victor, who is also a senior consultant. And today we are handling lesson 11 of the fixed assets module. And Victor, please walk us through.
Thank you, Bob, for the introduction. Welcome everybody to this lesson in our Financials Functional Training series. In this lesson, as Bob said, we are on lesson 11 of FA. We are still dealing with our book controls, but we are almost done. We have book controls is part of the overall or the big picture setup for FA, whereby we started by creating the key flex fields, the asset category flex field, the asset key flex field, and the asset location. We configured system controls based on those flex fields that we created. Remember, in the system controls, all we had to do was enter the flex fields that we are going to be using and the enterprise name that will be appearing on the reports. Now we're in book controls, which involves calendars, accounting rules, and natural accounts. And we are dealing with the natural accounts at the moment. Remember, book controls is basically creating our corporate book, okay? It's the same page we use to create our other books, budget books or tax books, but book controls is where you do the setups for your whatever book you're going to be creating, okay? Whether it's asset, tax, whether it's corporate tax or budget. So like we said, this is the navigation to go to the book controls via the FA manager responsibility. And these are the fields. We already dealt with these fields: the ledger, the fiscal year, the prorate conventions and calendars, and the calendar setups for book controls. And now we are dealing with the natural accounts. We talked about the accounts involved in retirement, okay? And now we are going to look at the natural accounts you have to create, and these are involved in depreciation. So we are going to discuss these three accounts, and after that we will have an understanding of book controls and we'll be ready to create our own corporate book. So let's start with the depreciation adjustment account, which is one of the accounts here. Perhaps so that we can have a clear picture, I should take you to the book controls page so that we can understand what we are doing. I know you've probably visited this page a couple of times, but let's just set the stage for what we are going to be doing. So this is what we are talking about, book controls. Maybe we can pull up a book that's already been created. So we are dealing with natural accounts. Just don't pay attention to what's filled out here. I just pulled out a corporate book here that belongs to this particular organization. So these are the three accounts we want to talk about: the deferred depreciation reserve, the deferred depreciation expense, and the depreciation adjustment account. We talked about these accounts here. I know we haven't mentioned these two, the net book value retired and the revaluation reserve retired accounts. We are going to mention them as we fill out these fields when we are setting up our corporate book. But for this session, we want to talk about these three accounts. So let's start with the depreciation adjustment account. The depreciation adjustment account is employed or is used when an asset is added to your FA module later than the date placed in service. and it accounts for missed depreciation entries. Okay, so that is the purpose of the depreciation adjustment account. We are going to look at an example so that we can understand what we are saying. But you can, an organization or a company can acquire an asset and put it in service, but that asset is added to the books later than the day when it was placed in service. Okay, so for example, if Maskani purchased a vehicle and they started using it in January, 1st January, okay, but they added it to the books on in March, okay, the FA. So when this vehicle was in service, it is supposed to be expensed, right, for those periods that have been missed, because it is being used, and therefore there are depreciation entries or expenses that have been missed before it was added into FA. So the adjustment account will take care of those missed depreciation entries. Why? Remember, in a production setting, once you run depreciation expense, or once you run depreciation, you also close the period, or periods are closed when all the reconciliation has been done, and you move to the next period. So it's not like this learning instance where we are doing everything without paying, particular attention to best practices or anything like that. So once a period is over and all the necessary accounting has been done and reconciliation, that period is closed. Okay, so if this asset was placed in service in January, but it is only being added in the system in FA in April, then you cannot run depreciation for those missed months, because you are in April, and when you run depreciation, it will be running for that particular period. Okay, so that's where the depreciation adjustment account comes into play, by calculating those missed entries, depreciation expense entries for that asset. So this is the example. We have this asset, the same example that we used. Perhaps don't pay too much attention to the other information like the cost. We want to see this date placed in service and date added in FA. So assuming this asset, let's say it's a vehicle again, was placed in service in March, 11th March. Let's assume we are using current month convention for depreciation. So according to that convention, depreciation will be calculated as if it's starting from the 1st of March. Okay. However, since this asset is only added in FA on the 1st of May, right? So depreciation entries for March and for April cannot be calculated. Why? Because this asset has not been added in FA. And in FA, once you add them to your books, that's when you can start calculating the depreciation expenses. So this is what I'm trying to show with this particular slide. The first journal entry or accounting entry is for asset addition. We took a look at this when we were talking about the retirement accounts for book controls. So this is what happens when you add the asset. Okay, and then let's say in May, right? It's added on 1st May. Okay, so in May because that's the period that is open. At the end of May, you'll be running your depreciation program. Okay, But remember, this asset was placed in service in March. So you've been having this asset and using it since March. Therefore, in May, the kind of accounting that will be created will be one, there'll be depreciation expenses not calculated for March and for April. Okay. So those entries will be calculated, and this is the accounting that will be created. So instead of going to the depreciation expense, those adjustments will go to the depreciation adjustment account, which is also an expense account. But on the other side is also accumulated depreciation, because of course this is still part of the depreciation for this asset. And then you will have the actual depreciation expense for May, which is the period you're currently in. Okay, so this is for May, while these entries are for March and April, which are these two periods which were not accounted for because your asset had not been added in FA, although it had already been placed in service. All right, so this is 5 plus 5 to give 10, assuming the depreciation expense for this asset for every period is $5. So that is the purpose of the depreciation adjustment account. It is for when an asset is added to your books later than the date it was actually placed in service. Pretty straightforward, right? Now let's talk about the next two accounts. The deferred depreciation expense account and the deferred depreciation reserve account. So the deferred depreciation expense account accounts for the difference between corporate depreciation expense and tax purpose depreciation expense. Okay? And it is an income statement account, all right? Basically an expense account, goes on your income statement. So remember when we were talking about corporate books and tax books and budget books, we said that companies are able to choose various methods or depreciation methods that will give them some benefits, and this is something that is allowed by authorities. So it's not like some cheating or something. So for example, like new companies may want to reduce their tax liability at the beginning when they're not generating too much revenue. So they might want to reduce their tax liability at the beginning and pay for it down the road. Okay, so they will have one method for corporate purposes, for internal purposes, and then they will have another method which they use to calculate their tax liability, which is what they show the authorities of how much they are going to pay. Remember, you pay your tax on what? On net income. So if you increase your expenses, then you're reducing the base for which you're going to pay your tax. Anyway, so what I'm trying to aim at is that there's going to be a difference between the amounts of depreciation expense generated for the corporate and for the corporate book and for the tax book. Okay, so for example, on your corporate book, you could be coming up for your assets with an expense of $100, but in your tax book you're showing an expense of $200. All right, so the difference is 100, and that difference is what is accounted for using the deferred depreciation expense account. So you have to report this to show that this is what we are saving by using this different depreciation method for our assets. Okay, so that is the purpose of deferred depreciation expense account. On the other hand, we have the deferred depreciation reserve account, and the way to think about it is it's what is on the other side when you create these deferred entries for your deferred depreciation expenses. So that entry will contain the deferred depreciation expense account on one side and the deferred depreciation reserve account on the other side. So if this is an expense account, which is what we have said, on the debit side, when you increase your expense, you'll have this account, deferred depreciation expense account. And on the credit side, you'll have this deferred depreciation reserve account, which basically shows your deferred like tax liabilities, okay, that you generate from these tax breaks by using a different depreciation method. And this is a balance sheet account. And what you're basically telling people who are looking at your financial statements is this is what we've been saving by using a different depreciation method, okay, just for like financial transparency, okay. So we need to have these accounts set up so that we can use them in our book controls for our corporate book, okay. So we have talked about the natural accounts, okay. These are the accounts that we will need to create in order to set up our book controls. And it's a total of all the accounts we've talked about. We have proceeds of sale clearing, okay. We have cost of removal clearing. We have gain and loss account. Then we have these three that we have talked about in this session, the deferred depreciation reserve, the deferred depreciation expense, and the depreciation adjustment account. So what I wanted to talk about now is this gain loss account, okay. So let's go back to Oracle. So now we know, let's again focus on these two, proceeds of sale and cost of removal. So for proceeds of sale, you can see we need to enter a gain account, we need to enter a loss account, and we need to enter a clearing account. All right. So by now we know what clearing account is. We also know what the gain loss account is. So what I want to explain is why do we have two different fields. So let's start. Clearing, we know it's the link between AR and FA, correct? So when you sell an asset and thereby you retire it, this is the link between FA and AR, because as we said, we cannot touch the cash account from FA. And then we saw that depending on how those transactions go, you can get a gain or a loss from selling that asset, right? So Oracle can have you create separate accounts for your gains and separate accounts for your loss, which is exactly what these guys have done here in the setup. All right. Perhaps I should use a new window without these values to confuse you, but maybe it will also help in learning. All right. But you can also have these as the same account. Okay. So if you create it as a revenue account, for example, then if it's a gain, you credit that account. If it's a loss, you debit it. Or you can create it as an expense account. If it's a gain, you credit it, and if it's a loss, you debit it. All right. Now, same goes for cost of removal. You can create a separate gain account, and you can create a separate loss account, or you can create one account and gains and losses from cost of removal, as we saw in our discussions about the purpose of these accounts, will be hitting this account. The other way you can do it, which is how we are going to do it ourselves, is to have one gain loss account. So instead of having one for proceeds of sale, instead of having another one for cost of removal, we are going to have one gain loss account associated with asset retirement, right? So any gain, whether it's from proceeds of sale, whether it's from cost of removal, any loss, whether it's from proceeds of sale or cost of removal, will all hit that particular gain and loss account. All right. And we can also do the same for these two other accounts, the net book value retired and the revaluation reserve retired accounts. So we can have one gain loss account serving that purpose for all these types, okay? The proceeds of sale, cost of removal, etc. So that is what I wanted to explain in terms of why we have these different fields. So if these guys implemented their setup the way we are going to do ours, then they would have, for example, all these fields filled with 7850 instead of these different natural accounts. And by the way, as you can see, we are filling the actual natural accounts values and not the combination. Okay. All right. So that's one thing. So the next question you might ask is, how will the system know, for example, which company it's generating these entries for? And that is what this account generator defaults field is for. Okay, so whatever you enter here, all the other fields will be replaced with the values you enter here apart from the natural account. So looking at this combination, I can assume that this third value here is the natural account. Okay. So when an entry is generated from this book, and let's say it affects the proceeds of sale gain account, it will be generated using these values, and this value will be changed to the appropriate one here. But all the other values will be picked up from here. Then the other thing is, remember we said that in order to associate a ledger with your corporate book, or in order to use a ledger with FA module, that ledger has to have a cost segment, and that is a qualifier, just like the natural account and the balancing segment that we have to assign to a particular segment. So I'm just talking about now the whole overview because we are pretty much done with the theory for the book controls. So I'm just it's like a prime of now what are going to be our next steps. So we have to assign our a cost segment, a cost center segment in our ledger, which we are going to do. And of course, we are going to talk about these accounting rules for a bit, but we're not going to change much in our setup. And now we are ready to create our corporate books, and we are going to do that starting from our next session, right? So Bob, unless you have something to add, we can end this lesson there.
Thank you, Victor.
Thank you.